Hi, my name's Dixon Gardner. I'm a California registered investment advisor. My email is dixongardner@hotmail.com. If you or someone you know is looking for such an advisor, please contact me. If you like this video, please hit the subscribe button and leave your comments. This video is my views about the commodity of silver. I'm not recommending that you make any purchase of silver as a commodity. I am against such a purchase because you face potential unlimited losses. That said, there are ways to buy securities to participate in silver, such as a trust that owns silver or a mining company. You rely on my views about silver at your own risk. Before I created this video, I owned a long position in Newmont Mining, Sprout Physical Silver Trust, Rio Tinto Group, BHP, and Glencore. All of these companies have operations involved in silver. I'm not recommending any of these stocks. This is purely an education video. I am not receiving compensation for this video. You conduct all investments based on your own analysis, and I am not responsible for any information provided by any of the sources for this video or to update it. All right, so in 2022, silver traded around $20 an ounce. And today it's trading over $117 per ounce. This video attempts to answer what happened to produce this price increase. The short answer is demand grew faster than supply, which barely grew at all. You're looking at a picture from Trading Economics of the silver price from early 2022, February of 2022 or February of 2021, all the way till today, $118.30. So let's dig down and see how the deficit was created in the market to drive the price up. Okay, in front of you now is a picture of a Excel spreadsheet that I took from Metal Focus 2018 to 29. From the Pan American Silver Corporation's 2024 quarterly presentation. This is also based on the Silver Institute and the World Silver Survey. So at the top, you have mine production. In 2018, it was 851 million ounces of silver. And in 2024, it dropped to 820 million. And this year, it's estimated at 835. We'll know in a few months, or maybe just a matter of weeks, on what the actual number was. That's worldwide supply. Recycling of silver has gone up, 162 million to 193 million ounces. Total supply, though, barely moved. 1,014 in 2018, 1,016 in 2024, and they only estimate 1,030 this year, this past year, and this year too. All right. So mine production is flat. Recycling is picking up, but not enough to produce a market equilibrium. So if we follow the price down here, the December silver price hit a low in December of 2019, $11.63. And at that time, the market was in surplus. Market was in surplus in 2018 of 14 million ounces. 10 million ounces in 2019, 6 million in 2020. So the trend has been a tightening market since 2018. Deficit of 80 million ounces in 2021, 250 million ounces in 2022, roughly 200 in 2023, 150 million in 2024. They're estimated 118 million ounces of demand over supply in 2025, expecting over 200 in 2026. Over 120 million ounces in 2027, and that a surplus in the market will not exist until 2028. So as the years go by and the deficit continues to expand, that means existing stocks of silver go down, creates scarcity, demand exceeds supply, and the price, as you can see, went from $11.63 till today, $117.35. All right. So let's dig down deeper. Mine production is not increasing, even though the price has increased 7 times in the last 7 years. And part of that is that over 70% of all silver is mined as a byproduct of other metals, such as copper, gold, lead, and zinc. It is difficult to find a silver deposit all by itself for a large-scale silver mine. Usually they find a large-scale mine for copper or gold, lead, or zinc. And then as they're pulling out those minerals, they'll also pull out silver. Recycling silver and electronics products as they're made today is not economical. These facts have produced a vertical supply curve that does not respond to price to increase supply. There's 1 million ounces in 2018 at $16 an ounce, and you don't get much more. 2 million more ounces in 2024. The price essentially doubled. All right, so you have a very vertical supply curve. And demand, you can see from the total industrial, 526 million ounces, 680 million ounces in 2025 estimated. Okay, so industrial photovoltaics, solar energy, cell phones, that is growing at a 12.3% compounded annual growth rate for the last 7 years, and that's generating demand in excess of supply. So you have demand is a positive demand curve, because as price goes up, consumption goes up, which is what is driving the price higher and higher. Now, the electronics demand is not going away. Cell phones and solar energy use are growing over time, and that means that the demand for silver is going to keep growing. That's why it's a critical mineral. And the cell phone that I'm using to create this video has silver in it. The computer that is showing the screen has silver in it. The solar energy panels that you may have around your house, car, or wherever, they use silver. And any solar energy devices, they have silver, but not enough to use as a recycling material. Another interesting thing about this chart is physical investment in hedging in silver, 173 million ounces in 2018, only is 204 ounces estimated for 2025. Went up to 356 ounces in 2022. Price went up roughly $10, and people started selling it off. It's very strange. All right. Silver used to be the poor man's gold and was usually worth less than gold. For example, the U.S. Constitution in 1787, a long time ago, made the gold to silver ratio 15-1. That was incorrect. And anytime you hear anything about gold silver ratios, and that it indicates some kind of value, I would put dubious next to that, since there's no fixed ratio and they can trade wildly different. So the current silver boom is not due to silver's monetary use, but its industrial use. And there's plenty of videos online about silver consumption as a critical mineral in today's world. So the big questions are, how high will silver go in price? And what price will be the equilibrium price where silver will trade in a narrow range of stable values, such as the oil market, where it trades between $60 and $80 in the last 4 years. So let's go look at what Pan American Silver put out. So the different graphs you can see in the graph. The green is the surplus. The red is the deficit. They anticipate a deficit until 2027. And then you'll have small surpluses in 28 and 29. So since 2021, we've had a deficit. 21, 22, 23, 24, 25 was a deficit. 26 is deficit. And as deficits continue, the price goes up. All right. So the two questions again, how high will silver go in price, and what price will be the equilibrium price where silver will stop going up? Problem is, no one knows the answers to this. There's no formula to compute the fair value of an ounce of silver like you can for a stock or a bond. There's no future cash flows other than selling the ounce of silver. And the deficit has created a shortage. All right, so there are lessons to take away from this other than just investing in silver. So when you evaluate any commodity, any miner that produces a commodity, or any type of commodity trust that owns a commodity, you have several questions that you need to provide an answer to. First one, and if you're going to go long, is demand consistently exceeding supply. Here, the market was in a deficit for the last 5 years, i.e. a shortage, and that has been a boost to moving the price up because demand is greater than supply. Then you need to ask yourself and determine how long will this shortage last. Okay, a mine takes over a decade to be brought onto production. This is why metal suppliers take time to meet demand and results in years of deficit. In contrast, natural gas, in the winter you have shortages, demand exceeds supply when cold weather hits, and in the summer you have surpluses to build supply. So shortages only last a few months, not years. Same thing with oil. In oil, you have overnight instability that creates shortages, wars, embargoes, severe storms, political instability in oil-producing countries, and OPEC shutting down production. These can all create shortages overnight, and they can create surpluses if the opposite occurs. Agricultural commodities are very tough. You have to wait for the harvest season to analyze whether demand will exceed supply. Then, even if there is a market deficit, you need to know when the next harvest is going to occur, whether it's going to be a few months or a year. Commodities with stable growing periods that are not frequent and can only be grown in specific geographic areas like coffee and cocoa in English, provide longer periods such as months where the deficit will last before the harvest begins again, as opposed to something like wheat, which is grown all over the world and harvested at different times all throughout the world. All right, another question you need to evaluate and answer is what indicators will signal that the market will be in a deficit, equilibrium, or surplus? You need to study those and keep track of those on a daily basis. So the strategy is if you're in a deficit where demand exceeds supply in the red area, you want to be long the commodity and companies that produce the commodity. Where demand equals supply, which is over here, you don't have much of a surplus or deficit, then you want to own a company that produces the commodity. And in a surplus, in the green areas, you want to be short both the commodity and the companies that produce the commodity, because companies will be losing money, the commodity price will be going down. Now, another signal, not in the video, but you should be aware of. When the market price of a commodity is less than its unit production cost. For example, if silver when it was trading below $15 a share, or $15 an ounce, back here in 2018 and 2019, you would know that because silver, the cost of silver is between $15 and $20, that the price has to go up. And it did. It went to $25 in 2020, went to $24 in 2021. So it's been above $20 an ounce since 2020. And you've seen a rebound from 2020 to higher production amounts from mines. And the reason that is when the commodity companies are having losses because their costs exceed their revenue price, they cut back on production. So that will create a shortage. Thanks for watching.